at this level, we understand that ledgers are items picked out from transactions for recording. And then we also understand that the trial balance is used to test the arithmetical accuracy of the ledger balances. Even at that, it is possible that the ledger balances will be tested with the trial balance and the trial balance will still agree. In the agreement of the trial balance, there might still be some errors in the transaction recording. These errors do not affect the trial balance. So in this class, we are going to be looking at errors not affecting the trial balance. These are errors committed in recording transactions in the ledgers without creating a trial balance difference when tested. What I am trying to say is that despite the fact that the trial balance agrees, it is possible to have errors committed while recording transaction. When errors are spotted in entering transaction into ledgers without affecting the agreement of the trial balance, they are referred to as errors not affecting the trial balance. In a nutshell, any error that is observed in recording transactions into the ledger that will not throw the trial balance into difference is referred to as an error not affecting the trial balance. Having established the fact that there can be errors that the trial balance will not reveal, let's look at those errors that do not affect the trial balance. We have errors of omission, errors of commission, errors of principle, errors of original entry, compensating errors, and complete reversal of entries. The first one here says error of omission or exclusion. The word omission here means to ignore or an oversight. So it is possible that while recording transactions, one or two transactions might be what? Ignored or excluded from the books. Such error is called error of omission. What I'm trying to say is, anytime a transaction is not recorded at all, the bookkeeper or the accountant has committed an error of omission. For instance, rent paid in cash has two ledgers, rent account and cash account. Cash is an asset increasing or decreasing rather, I beg your pardon. So you credit cash, and rent is an expense increasing, so you debit rent. Now, instead of entering this transaction into cash account and rent account, none was actually recorded. Such error is called error of omission. The next one is the error of commission or order. Here, we are saying that in the transaction, the right entries were made, but the wrong person's account was taken into consideration. For instance, payment made to Mr. Chidi entered into Mr. Chima's account. The error committed here is that instead of recording into Mr. Chidi's account, we recorded into Mr. Chima's account. So there has to be personal accounts here. Such error is called error of commission or error of what? Order. Error of principle or error of ruling or error of standard. Remember when we were treating books of accounts under the sales day book and the purchases day book, I said that the sales day book is for recording sales made on credit, and it must be goods that the company or the business deals in. The same thing for purchases day book. For purchases made on credit, and it must be goods that the business deals in. I explained to you that where you buy or sell an item other than what the business deals in, it is not recorded in the sales day book. Now, where the accountant or the bookkeeper records an item sold that is not what the business deals in into the sales day book, such error is called an error of what? Principle. So by definition, we say the error of principle or the error of ruling or the error of standard is an error where the right entries are made for a particular transaction, but a corresponding entry was made in the wrong category of account. For instance, you purchased equipment, or you purchased furniture, or you purchased motor vehicle, and then you recorded it in the purchases day book. Remember, the purchase day book is for only recording purchases made on credit, and the goods must be what the business deals in. Equipment is not what the business deals in, it's an asset here. So recording an asset in the purchases account is an error of principle. The next one here is error of original entry or incorrect value. What it means is that in the transaction, the right entries were made in the right account, but the wrong value was used. Take for instance, cash payment to Mr. Ben, $350. You're supposed to what? Credit cash with $350, debit Mr. Ben with $350. But instead, we credit cash with $530 and debit Mr. Ben with $530. You observe that the right account, which is cash and Mr. Ben, were opened. The right entry, which is to credit cash and debit Mr. Ben, was done, but the wrong value was used. So instead of using $350, we used what? $530. Such error is an error of what? Original entry or an error of incorrect what? Value. The next one is the compensating errors or cancelling errors. This is a situation whereby an error committed in recording a particular transaction is cancelled out by an error committed in recording another what? Transaction. In a simple explanation, what I'm saying is, while recording one transaction, there was an error. Now, in recording another transaction, there was an error. The error made in the second transaction cancelled the error made in the first transaction. Such error is called compensating errors or cancelling errors. For instance, cash purchases. We have two accounts there, cash and purchases. Now, if I understate the value in the purchases account, that's an error in the first transaction. Now, we now have sales for cash. That will be cash and sales. Now, if I understate the value in the sales account again, it means that the error in the second transaction, which is transaction sales and cash, is cancelled by the error in the first transaction, which is what? Transaction cash and what? Purchases. Such kind of error is what we call compensating errors. The last one here is complete reversal of entries. Look at the word reversal. To reverse. Instead of moving forward, you moved backward. Instead of moving backward, you moved forward. So let's put that in the transaction. In every transaction, there must be a debit entry and a corresponding credit entry. Now let's assume in a transaction, the account that you are supposed to debit, you credited. And the account you're supposed to credit, you debited. Such error is called complete reversal of what? Entry. For instance, we have cash sales of 10,000. Normally we have two accounts, sales and cash. Remember, if you sell in cash, cash is an asset, it increases. What do? You debit. Sales is an income, increases. What do? You credit. But instead of what? Debiting cash and crediting sales, you are debiting sales and crediting what? Cash. That's reversing the what? Entry. So we say you've committed an error of what? Complete reversal of what? Entries. Now that we understand the type of errors that does not affect the trial balance, we must now know how to correct them when we what? Observe that we've committed such what? An error. So when we observe that an error has been committed, we what? We identify the ledgers affected and then raise Jonahs to correct the errors with a narration. Now, recall in the books of account, we talked about what? Specific books and non-specific books. Specific books are books used for recording specific transactions. We gave examples: sales day book, purchase day book, returns inward book, returns outward book, cash book. And now there is a non-specific book of account. That is what we call the word Jonah. Any transaction that cannot go through the specific books of account is usually recorded through what? The Jonah. So we can say the Jonah is a book of account that records transactions that cannot pass through the specific books of what? Account. Because the Jonah what? Proper. The Jonah has columns for description of transaction, debit, and what? Credit. In a nutshell, when there are errors, for us to correct them, we raise Jonahs. Now this is how a Jonah looks like, Jonah proper. So we have the Jonah description here, item to be debited in value, item to be credited. As I was saying, the Jonah proper, we have the Jonah here, the description of the transaction, item to be debited in value, and item to be what? Credited in what? Value. Here is an illustration on how to correct errors not affecting the trial balance. Here we have an illustration saying, after going through the books of Amenyon Enterprises, the following errors were discovered. The first error says a payment for rent by check, 450,000, has been completely omitted from the books. Second one here said a receipt of cash worth 120,000 for goods sold has not been recorded at all. The third error here said a purchase of equipment worth 320,000 has been recorded in the what? Purchases account. The fourth error here said the purchase day book has been overstated by 17,500. So also the sales day book. The fifth one here says a payment of 56,000 to Mr. Wellington has been entered in Mr. Kingston's account. The sixth one here said a payment of 5,400 cash to Lekki has been entered in both sides of the account as 4,500. The seventh one here said a payment for motor repairs in cash 3,500 has been recorded in the motor vehicle account. Now these are the errors identified in Ameyon's Enterprises books. So what do we do? First of all, we must be able to interpret the interpret the error in the transaction before we raise the word Jonah. And don't forget, you must know your rules in terms of assets, liabilities, income, expense. That will help us to correct the errors. So the first question here says, a payment for rent. A payment for rent by check, 450,000 naira, has been completely omitted from the books. So let's interpret the error. Here is interpretation. Transaction has two accounts, which is rent and bank, completely omitted. What am I trying to say? If you look at the error, they said a payment for rent by check. That means there was a payment made for rent and check was used for it. So that means in that transaction you have bank and rent. But they're not saying that it has been completely omitted from the books. That means it was not recorded at all. So the way to correct that error is to record it. So how do we record it? To do the normal double entry. Identify the accounts involved, credit the one that needs to be credited, and debit the one that needs to be debited. So from this transaction, we have rent and bank. So rent here is an expense. It is increasing, so you debit it with 450,000. Bank is an asset. It will decrease, so you credit it with 450,000, then you narrate. Now here is the journal for correction. We have Ameyon Enterprise, Jonah. So this is the description. We have the debit amount and the credit amount. So in order for us to correct the account, we have raised an entry. We said rent is to be debited and bank is to be credited. So rent here is debited with 450,000. Bank is credited with 450,000. So let's narrate. Being entry for correction of error in which a complete omission of payment for rent is made. I told you when you raise the journal entry for correction, you must narrate. So we have raised the journal entry for this omission now, which is to debit rent and to credit bank, and then we narrate. The next error says a receipt of cash worth 120,000 for goods sold has not been recorded at all. This is another error of omission. We received cash for goods sold. So there are two accounts there, cash account and sales account. Cash is an asset. Sales is an income. We received cash. Cash is increasing, so cash will be debited. Sales is an income increasing to be credited. So we have the entries. So because they are omitted, means they were not recorded at all. We just go ahead and record. So let's go. Cash is to be debited. We have cash debited with 120,000. We have sales credited with 120,000. So we narrate. Being entry for correction of error in which cash receipt for goods sold wasn't recorded at all. Let's go to the third error. A purchase of equipment worth 320,000 has been recorded in the purchase account. Remember, this is an error of An error of proof. Let's interpret that error. That's what I've done here. Transaction has an amount for equipment account entered into purchases account. When you purchase equipment, you can't take it to purchase account because equipment is not what the business deals in. Equipment is an asset in this case. The purchase account only records goods that the business deals in that are purchased. So in this case now, the amount belonging to equipment has been entered in what? Purchases. So we must now identify what entry was made in the purchase account. So if we purchase on the normal circumstance, we debit purchases. But in this case, we purchased equipment, which is an asset. So equipment ought to be what? Debited. But instead of debiting equipment, we credited what? Instead of debiting equipment, we debited purchases. So the value of 320,000 for equipment has been debited in error to purchases account. So for us to take it out of purchases, we'll credit purchases and then debit the account that has it. So let's go now. The account that has it is equipment. Equipment here will be debited 320. We'll credit purchases with what? 320. We are crediting purchases here so as to bring out the 320 that was there. And then debit what? Equipment. So we'll narrate. Being correction of error in which purchases of equipment was recorded in the what? Purchase what? Account. The next one. D says the purchase day book has been overstated by 17,500. So also the sales day book. Let's interpret that now. We say transaction has two accounts, purchases account and sales account overstated. So they are telling you that the purchase account is overstated. To overstate means to enter a value higher than what ought to be entered. Instead of entering 10 naira, you entered 15 naira. Instead of entering 20, you entered 25. That's what they call overstatement. So they are saying that the purchase day book has been overstated by 17.5. So also the sales day. So the purchase day book is overstated. The sales day book is over what? Stated. So we have to what? Bring it down. Under your trial balance rule, remember, purchases are expenses that what has debit balances. Sales are income that have what? Credit balances. So we can interpret it as what? That what the purchase account has been what? Debited with what? An excess of 17.5, and the sales account has been credited with an excess of 17.5. So if the sales account is credited with an excess of 75, the way to take it out is to debit the sales. If purchase account has been debited in an excess of 17.5, the way to take it out is what? Is to credit what? Purchases. So let's take that journal entry. So we'll see sales here debited with 17.5, and then we'll see purchases here credited with 17.5. So we'll say being correction of error in which sales and purchases was what? Overstated. The next one. A payment of 56,000 to Mr. Wellington has been entered in Mr. Kingston's account. This is an error of order, error of commission. Told you error of commission has to do with what? Individuals, personal accounts, organizations. The payment was made to Mr. Wellington, but it was entered in Mr. Kingston's account. So that means that what ought to have been entered in Mr. Wellington's account is in Mr. Kingston's account. So if you make payment to Mr. Wellington, you're supposed to what? Debit Mr. Wellington and credit your cash. So cash is settled. But the issue here is that it was supposed to be for Mr. Wellington, but it has entered in Mr. So instead of debiting Mr. Wellington, they have entered into Mr. Kingston's account. So we have to take it out of Kingston's account and take it back to what? Wellington. So if Kingston has been debited ab initio in error, then it has to be credited to bring it out. So we'll now debit Mr. Wellington, which is the what? Original account owner. So here I will say Mr. Wellington is debited with 56,000. Mr. Kingston is what credited with what 56,000. So we narrate to say being correction of error in which payment to Wellington was entered in Kingston's what account. The next one here, F, says a payment of 5,400 cash to Lekki has been entered in both sides of the account as 4,500. Now, when you make payments to Lekki in cash, you have two accounts, cash and Lekki. You credit cash and debit Lekki. Now, the payment is 5,004, but they've entered to both accounts as what 4,005. What error is that? If you recall, that's error of original entry or incorrect what value. The account involved is cash and Lekki, which ought to be 5,004, but they've entered 4,005. So in a nutshell, they've entered a lesser amount. So we have to what? Add the shortage. So if you're supposed to enter 5,4 and then you entered 4,5, the difference is how much? 900. So you have to add down the naira to the accounts. So what do? Cash ought to be credited. So we credit cash with 900, debit Lekki with what? 900. So here we have Lekki here debited with 900, cash credited with what? 900. So we narrate being correction of what? Error in which cash payment to Lekki in cash for 5,004 was entered as 4,005. So the last one says a payment for motor repairs in cash 3,005 has been recorded in motor vehicle accounts. Can you see that? The money was paid for motor repairs but was entered in motor vehicle account. You know that error of what? Error of principle. Error of principle or error of rules or error of standards. Motor vehicle is not the same thing as motor repairs. Motor repairs is an expense. Motor vehicle is what? An asset. So the payment was for motor repairs, but it was entered in motor vehicle account. So the error entry was a debit into what? Motor vehicle instead of what? A debit into motor what? Repair. So for us to take it out of motor vehicle, we credit motor vehicle so we can debit motor repairs. So what do? We debit motor repairs with what? 3,005 and credit motor vehicle with 3,005 and then narrate being correction of error in which payment for motor vehicle repairs was entered in motor vehicle accounts. So that is the illustration on errors not affecting the trial balance. I will encourage you to pick questions and try correcting errors. Identify the type of errors and then raise Jonahs to correct them. If you have issues, questions for clarifications, you can reach me on 08136506356 or send me an email, jeremiah.dosu@gmail.com. You can drop questions in the comment section or send me a DM. I'll be there to respond with answers. Thank you.